Welcome to the Real Pros of DC. Each week we interview some of the DC metro area's top professionals and discuss topics related to this unique real estate market. I'm your host, William McCoy, and this is the Real Pros of DC. Welcome to the Real Pros of DC, where each week we interview some of the DC metro area's top real estate professionals. I'm your host, William McCoy, and I have on here my co-hosts, Paul, Amanda, Alicia, and we have Dan from Movement Mortgage. Dan, thank you for coming on the show.
Good to be here. Thanks for having me.
Awesome. So tell us, Dan, how did you get into the mortgage business?
I practiced accounting for about 5 or 6 years with a CPA firm. I had a small client that was in the mortgage business. I took a real liking to the mortgage business, and I've been originating mortgages ever since, 33 years.
Wow. A lot of experience.
I was 4 when I started.
Yeah, pretty much.
So what do you find is the biggest misconception with first-time home buyers?
Probably the biggest misconception is you have to have 20% down. It simply is not true. Most people think it just even by your reaction. We have all sorts of loan programs, some of which require no money down. There's some really good programs geared towards that first-time home buyer market.
Where did that 20% question come from? Where did that come from?
Within the industry, 20% is a magic number because on many programs, and I'm talking generally now because it can change from program to program, if you put 20% down, you can avoid something called PMI, private mortgage insurance, which sort of has a bad reputation, but it's really a very useful and effective tool for people that can't put 20% down, where a down payment's required. So I think that has just sort of carried throughout the industry for people to think incorrectly so that you have to have 20% down to buy a house. And that applies not only to first-time home buyers like you brought up, but across the board to all home buyers.
So first-time home buyers worry about expenses, and they worry about a fixed-rate mortgage versus an ARM, an adjustable rate mortgage. Can you explain the pros and cons of the two?
And I would expand that. That's not just first-time home buyers,
Everyone.
But really it's everybody, but particularly first-time home buyers. And the difference between the two is that on a fixed-rate mortgage, the principal and interest payment will never change for the life of the loan. It's a guaranteed rate for 15 years, 30 years, whatever the term might be. On an adjustable rate mortgage, the acronym ARM, the rate can change. So you as a homeowner are assuming some of the risk in terms of what happens to interest rates. But risk is not necessarily a bad thing. Risk is something to be managed, not to be avoided. I walk into the parking lot after this show and I have a risk of getting hit by a car. It's looking both ways to manage that risk. I myself, for the last 15 years, have had an adjustable rate mortgage on my home, and I've had a lower interest rate over the term of that 15 years than I would have had a fixed rate. If you want the stability, you might want to consider the fixed rate. If you can deal with the ebb and flow, or you might only be in a home for a short period of time, 3, 4, 5, 6, 7 years, you might want to consider an ARM. I will say the benefits of working with a mortgage lending professional, a human being, cannot be overstated because a monkey can actually take a loan application, can be trained to do it. It's not rocket science. It's the skills, it's the knowledge, it's the expertise, it's the advice that an individual lender like me and a few others can give to a home buyer that really helps them to match what type of loan is really best for their needs. It's ultimately their decision. But many years ago, there was a large chain of clothing stores, Sims, and their tagline was, an educated consumer is our best customer. It couldn't be more true of the home buying and financing process.
It's so funny. I had clients that had taken out ARMs, and then they were coming to end of term, and they panicked that it's going to go up, but interest rates had actually dropped. So their payment actually went down, but everyone assumes that when an ARM ends, that the payment's going to go up, but it's actually going to become with the current rate.
Adjust to the market, and I'm glad you said that because that is another huge misconception within the industry, is that an ARM after 5 years, let's say, is going to go up. That may or may not be true.
Could.
It could, and you
It
have
could
to be
also go
ready
down.
for that. But you also have to look at, if I'm getting a discounted rate because I'm willing to share that interest rate risk with the lender, for a year or two, if it's higher, what's been that blended rate over 5 or 6 years? That's why, in my case, I've kept my ARM. There have been some years that my rate has been higher than had I taken out a fixed rate, but over the course of 15 years, I've paid, on average, a full % less than had I taken out a fixed rate.
In your experience, like as far as traditional and ARMs, how much have you seen as far as the ratio over time? More people having the traditional loans or more people doing the ARM?
That's a really good question, and the answer over the 33 years is it really depends on the economic environment in which we're in. You know, when you can lock in an interest rate at 3.5% or 4% for 30 years, and let's say the rate is 4%, you can get 3 3/4 on an ARM. That differential really isn't that great. I will tell you, best prediction that I can make, and I don't have a perfect crystal ball, but the best prediction I can make is that quite possibly next year, as rates have risen over the past year or so, we could very well see a lot more ARMs being originated than fixed rates have over the past couple of years. It really depends on two things. It depends on the economic environment in which we're in, and that changes over time, and it depends on what you as a home buyer, what your particular situation and circumstances are.
For a first-time home buyer, besides, I guess, the mortgage, what other additional expenses can they anticipate?
Again, the way you worded the question is interesting because, again, not just for first-time home buyers, but for all home buyers, when you purchase a property, there are associated costs with that. There are closing costs, and broadly categorized into 3 categories: lender fees, title company fees, and government fees. There are recording taxes and fees that go to your local jurisdiction. A title company, which actually performs the settlement, ensures that you have what's known as clear and perfect or insurable title. They get their fees. And as a lender, we want to make some money. We don't make money necessarily off of the interest rate that we charge, although some do, but most do not. So there are fees associated with it, and that pot is sort of consolidated at the time of closing. Interestingly enough, first-time home buyers oftentimes get a break on some of those fees, particularly with the more expensive fees, because the recording fees, sometimes called recordation taxes, are oftentimes waived for the first-time home buyer. So for a first-time home buyer, the fees can actually be less than for any other type of home buyer.
Is that in specific jurisdictions?
It ranges. You know, in this jurisdiction, we're in Montgomery County, Maryland. You know, it's expensive to buy a home. If I'm going to give you a quick and dirty rule of thumb, I would assume 3 to 4% of the sales price are going to be bottom line in what your closing costs are going to be. However, with the regulatory changes that occurred about 10 years ago, as lenders, we're required to provide every borrower, whether it's a refinance transaction or a purchase transaction, something called an LE, a loan estimator, within 3 days of a completed application being submitted. And that outlines in great detail, tremendous detail, what those costs are. And there can be very little variance from those during the process. Some things can change, some things sometimes come up, sometimes you don't need to spend money on something that you projected you might have to. But within 3 days of making an application, you're going to know exactly how much money you're going to need to bring to the settlement table.
So there are two amazing things that are happening right now. I think we all know. There's this big transition of wealth, right? Baby boomers are starting to move money over to their children. But I also saw the other day that a lot more millennials are putting importance on buying a home and also even over having children, right? Or having a big wedding. They choose a smaller wedding and buy a home. So I foresee that there are going to be a lot more first-time home buyers. What programs are out there for this influx that I imagine is going to eventually happen?
A number of years ago, Fannie Mae and Freddie Mac, which are the 2 largest purchasers of mortgages in the secondary market, they're so big that they really, in many ways, set the standard for what the industry does, came out with a program that for first-time home buyers, they can put down as little as 3%.
Wow.
Of the sales price. So going back to the earlier question, the misnomer about 20%.
So no 20. Okay.
No 20. 3.
Yeah.
Within different jurisdictions, there are oftentimes programs, and Maryland has some exceptional programs for first-time home buyers, whereby they do not have to have a down payment. They still will need some money to bring to the settlement table for closing costs, but the down payment can be 0. And in fact, there are 2 programs within the state of Maryland whereby a home buyer, and this goes back to the millennial question, that oftentimes are straddled with student loan debt, where those student loans are essentially paid off at the time of closing. So there's some intricacies that I'm not sharing all the details to spare time, but essentially you can buy a house and pay off your student loans at the same time.
Listen to that.
Right.
Wow.
It really is incredible.
Yeah.
Yeah, that's incredible. I mean, again, that's a lot of my clients, even including my wife and I. We're moving up to a bigger home, but this is a huge question. What am I going to do with these student loans? Do student loans actually impact the loan application?
They can, and they can primarily from the standpoint of what the required monthly payment is. A mortgage, your mortgage, her mortgage, my mortgage, anybody's mortgage is generally approved based on 4 criteria: income, assets, credit, and security. And the income portion of that, we look at a ratio of what your income is and compare it to what your debts are, or really what your debts are in relation to what your income is. If you have high monthly payments on student loan debt, it can impact your ability to qualify. The nice thing about this Maryland program that I just mentioned is that not only are they essentially, they're not technically, but they are paid off at closing, but then we don't have to count the payments on those against you. So a lot of times you might have a millennial with a lot of student loan debt and maybe a car payment. They have to buy a car so they can get to work every day. And they pay their credit cards off. There's no extraneous debt. And I would say that student loan debt, if you're going to have debt, is a good type of debt. It was used not frivolously. It was used to help your education and to better your life and career. But we can get rid of that student loan debt potentially and not have to count it against you, so it can make qualifying easier.
That's absolutely incredible.
Who's
Larry
paying
Hogan,
that?
I believe, was who
You're exactly
started.
right. That was a program that Governor Hogan.
So is the state of Maryland paying for to pay off the student debt?
What typically happens is that at the time of settlement, and again there are some restrictions. I'm not giving you all the fine print, but from the overview, what essentially happens is that you have, let's say, $25,000 worth of student loan debt. That the state pays that off and attaches a second trust to the house. You do not have to make a payment on that second trust. No payments at all. And over 5 years, 20% of that student loan debt, that second trust, is written off. Wow. You never make a payment and it just goes away. Now, if let's say you only keep the house for 3 years, you're on the hook for 40% of that student loan debt still. But most people, the average life of a mortgage in the Washington, D.C. metropolitan area is about 4.5 years. And that's lower than the amount of time that the average person stays in their home. But again, you're getting rid of a substantial amount of debt, even if you move and sell that house over those first 5 years. If you're in the house 5 years or more, on that 60th month, the second trust is gone, and you've never made a payment.
Do you guys hear that?
Incredible. I
That
mean,
That's amazing.
that is the biggest issue with millennials.
Yes.
I mean, the polls have
It's
shown
huge.
that the student loan debt is crippling for a lot of people.
Well, Dan, this has been a lot of great knowledge. I mean, we would love to talk on and on about this. How do people get in contact with you?
2 ways are best. My phone number is 301-329-8882. Again, 301-329-8882. Or always by email, dan.caplan with a C. C-A-P, like Peter, L-A-N, dan.caplan@movement.com.
Thank you so much, Dan, for being on this show.
Thanks for having me.
Appreciate it. This has been awesome. Thank you guys for joining us this week. We'll see you next time. Thanks for joining us on this episode of The Real Pros of DC. Have a real estate topic you would like us to discuss? Go to www.therealprosofdc.com and submit your idea and see footage of the show. See you next time.